Hello, everyone, and welcome to the first installment of Alliance Advisors and the Cape Town Stock Exchange's ESG webinar series. In this three-part webinar series, we will examine environmental, social, and governance issues in the United States, as well as in South Africa. And what we're going to try to do is we're going to try to identify cross-continental trends and highlight any key differences in the priorities or attitudes towards various ESG issues. Each installment is going to focus on one specific issue, with today's webinar focusing on the E in ESG, environmental. Climate change, as we all know, is heightening the focus on the environmental issues, with many investors today calling for companies to reduce their GHG emissions with a goal of reaching net zero greenhouse gas pollution. Just this week, it was reported that a new UN report found that despite governments' efforts to try to adapt to climate change, we're still behind the 8 ball, and the current level of preparedness is insufficient to avoid far-reaching economic and health consequences. Today, we're going to provide an overview of some of these key environmental issues and considerations from a United States and South African perspective. We'll also look at some of the issues from various constituencies' viewpoints, and we have some different constituencies that are on the line today. If you have any questions during the presentation, please feel free to submit your questions through the chat box feature, the question feature that you have on your screen. And if we're unable to get to them during the webinar, we'll do our best to reply to you directly offline. So before we get started, as you can see with the slide that's now before you, I wanted to go over a couple of housekeeping items so that you guys all know how you can participate in today's discussion. We've taken a screenshot of an example of the interface that you should all be seeing on your screen. It's probably on like the upper right-hand corner of your desktop. When you joined, you either selected to join via computer or via audio, phone audio, excuse me, and you can toggle between those two if one of those functions stops working for you. You also have the opportunity to submit questions, like I mentioned, and all you have to do is just type your question into the question pane of the control panel, send it through, and we will be able to see it. So we hope to get some questions, so please don't hesitate to submit any if you have some questions that you would like us to opine on. I also included a few articles. We also included a few articles that you can download via the handouts section. So if you go to the control panel and you open it up, you can see there's about 4 articles that you can look at. They discuss some of the various proxy voting policy changes from a US perspective for the big 3, BlackRock, Vanguard, State Street, as well as the key advisory firms, Institutional Shareholder Services, ISS, and Glass Lewis. But before we jump into the big discussion today, let me introduce myself, and then each of the panelists will whip around the room, and they'll introduce themselves as well. So my name's Brian Valerio. I'm a Senior Vice President with Alliance Advisors Advisory Group. And in this role, what I do is I work with C-suite executives, board members, and their advisors on various corporate governance, environmental and social, as well as proxy solicitation issues. A lot of my work focuses on shareholder engagements, preparing public company clients to engage directly with their shareholders on some of these pressing ESG issues. So that's my perspective. Hillary, why don't you tell everybody about what your various roles and responsibilities are with Gibson Dunn?
Sure, Brian. Thanks for having me. Hi, everyone. I'm Hillary Holmes, and I'm a lawyer. I am a partner with the global law firm Gibson, Dunn & Crutcher. I'm based in their Houston, Texas office here in the U.S. And my practice focuses on counseling clients with strategic and long-term capital raising, complex mergers and acquisitions, and a lot of ESG counseling. I spent the last 20 years neck high in the energy industry, so ESG has almost organically been part of our discussions for a couple decades before we had an acronym to label it with. So I'm very pleased to be here to talk to you about the US perspective today.
Hi everyone, it's Eugene Boyson from the Cape Town Stock Exchange. I'm the CEO of this new venture that's been in place for the last 4 years, based out of Johannesburg and Cape Town. The Cape Town Stock Exchange is a big supporter of the UN commitments to sustainable development goals. We sit at the southern tip of Africa. It's important in terms of what it means to us not just in terms of sustainable finance, water security, food security. We've looked at this underlying project around how can we increase the underlying visibility, how can we increase the knowledge base as related to sustainable finance, and we hope these sessions become the first of many in terms of growing out that knowledge base. And if I can hand over to you.
Hi everyone, thank you. I'm Hendrik Snyman. I'm the Chief Investment Officer of a infrastructure investment firm based out of Cape Town. We invest in infrastructure assets, and naturally as part of that, a big subset of that is renewable energy. In my day-to-day, I get to rub shoulders with investors, and naturally they ask us many of the ESG related questions, with E being at the forefront often in the investments that we make.
Well, thank you all so much for joining today's discussion. We hope for a lively conversation that involves some interaction with the audience. So we're going to start today's discussion by providing a high-level view on the most important E considerations from both the US and a South African perspective. I'll start with the US side. So on the US side, the focus on climate change has dramatically increased in recent years, with investors now calling for companies to increase disclosure on key environmental metrics and also on how their boards are evaluating the risks and opportunities climate change is presenting. Explicit oversight by the board on material environmental issues is becoming the expectation for public companies, with some investors, including BlackRock, voting against individual directors for perceived failures on this type of issue. Many investors are calling for companies to include disclosures that are consistent with the Task Force for Climate-Related Financial Disclosures. The abbreviation that you probably have heard is TCFD. And this framework focuses a lot on the greenhouse gas emissions and these disclosures, and they're viewed as being so important because this is viewed as a first necessary step towards the process of reducing carbon emissions. So the 2020 proxy season, unprecedented levels of support for shareholder proposals and growing opposition for some directors. This was due in large part to some of the largest institutional investors evolving their voting patterns and voting against company recommendations, either in the form of voting for shareholder proposals or voting against management recommendations, management proposals, when they previously wouldn't have voted in such a way. The large passive index funds, the big three, have embraced environmental issues and ultimately have taken more of a broader, larger stakeholder perspective. And in doing so, they've voted far more frequently for environmental shareholder proposals. If you throw in the Biden administration's interest in potentially having SEC mandated climate disclosure, you can see a clear pattern that is developing. Public companies must pay attention to environmental issues in ways that they weren't required to just a few years earlier. So that's where I'm viewing as kind of the big picture items on the US side. Eugene or Hendrik, I'd love to get your guys' perspective on what you're seeing on the big picture side in South Africa.
So the exchange plays quite an important role in terms of putting the knitting together. So we've got an investor relations component, got an infrastructure component, we've got a issuer component, investors, and all the stakeholders are pulled together on the platform. The Cape Town Stock Exchange is an affiliate member of the World Federation of Exchanges, and it set 5 challenges to exchanges in terms of sustainable finance. The first of those was to educate participants in the exchange ecosystem and get everyone up to speed, what the developments are, what was happening, and the importance of sustainability issues. The second was to create and promote and enhance availability of information, investor relevant information, and decision useful information to participants. The third was to engage all stakeholders and make sure they all advance the underlying sustainability issues. And then thirdly was around, could we create a market with a relevant set of products to help engage not only investors, but also issuers in terms of getting their finance objectives achieved or their equity objectives achieved. And then more importantly, could we reorientate or create those financial flows that they were more sustainable? And then lastly is the exchange operates slightly differently from the US in that in South Africa, exchanges are the regulating entity for issuers, unlike in the US where it's the SEC. So could we establish effective internal governance, internal control, internal operational processes, and more importantly, disclosure obligations on our underlying issues, all in support of those sustainable finance initiatives? And I think that's where we'd like to make the focus and the exchange's contribution to the discussion.
Yeah, from my side, from the investor side, and having to look at a number of investments, what we see is that, like it's always been sort of the case, is that South Africa is probably 5 to 10 years behind Europe and the US with regards to disclosure requirements. So most of the companies that are actively disclosing or sort of pursuing an open environmental policy and trying to become more environmentally conscious are doing so to attract international capital, where this has been a requirement for some time. The other local firms that don't perhaps do that is doing a thematic as a thematic focus, and they pivot to the easy one, and that is to rely on renewable energy to displace some of the fossil fuel-based energy that they are currently using. From an investor perspective, you know, there is an increasing view, given that they understand the importance that they have with where they put their money is where their vote is. So increasingly, we are getting the question, what is your environmental policy and impact strategy? But still, to this date, I believe that financial considerations are the priority, with an environmental or social or governance disclosure or impact strategy being secondary to the financial returns.
Thank you guys for providing that perspective. I think at this point, Hillary, do you want to dive a little deeper into some of the key issues on the US side?
Yes, happy to do that. So we don't have time to go into a whole primer on the situation with respect to the E and ESG in the US, but here's a flavor for some of the issues US companies are working through on those topics that Brian highlighted in his overview. So board level oversight. So boards are being held accountable, and most of them are heeding the call, some are resistant, to embrace their responsibility with respect to understanding environmental issues and how they impact the company. And how they impact the company could be something indirect, like we're losing access to capital because we're not being responsive to demands of investors, lenders, and other stakeholders. Or it could be something direct, where climate change has a direct impact and creates new risks with respect to operations because of weather or because of increased costs or other compliance matters that they have to spend resources on. And oversight of the E in ESG is consistent with the duties of corporations in the United States. Most of the publicly traded corporations are formed in the state of Delaware, which imposes a duty of oversight. So a duty of identification of risk and then management of risk, identification of opportunity and management of the execution on opportunity. And managing the E and looking for opportunities within the E are consistent with the fiduciary duties that a director must fulfill by law. Investors definitely expect board level oversight. There's several of the large institutional investors and even some advisory firms expect a company to make clear who at the board level is responsible for oversight on E and other ESG issues, whether it's a committee or otherwise. And then in addition, it's important for directors of the board to understand environmental matters as a strategic business opportunity. So sustainable financing in the United States has grown exponentially from basically zero to a very healthy number over the last only 3 years. It started in Europe and made its way to South America, and now the US is embracing it and it's catching on like wildfire. So instead of doing regular credit agreements like we used to do all the time, companies are routinely considering opportunities for better interest rates, better covenant packages, if they tie the lending opportunity to a commitment to make a certain sustainability, to meet a certain sustainability goal, as an example. There are other examples, but there's opportunity within the E as well, and the board should know about it and should consider executing on it if appropriate. So when the board's thinking about how to execute on board level oversight, it always comes up whether a specific committee should be responsible for the climate related oversight. And having a committee of the board rather than the whole board focus on this area can help execute on the oversight function, can just help with efficiency and effectiveness. It depends on how large the board is and how large the company is, and certainly how their governance functions. But for a lot of larger companies, it's going to make sense to have a committee. Most US companies have actively addressed the responsibility to a committee and revised the charters that exist of an existing committee or constituted a new committee that's responsible for either sustainability or for all of ESG. Although sometimes certain components of ESG get broken off, so the E will be separated out such that certain topics get put with the audit committee like cybersecurity or the nominating and corporate governance committee, which most major companies are required to have by stock exchange rules, and they'll give them responsibility for human capital management and sort of other things in the S and the G. A related issue that's not on the slide but that flows from this is, okay, the board is responsible for oversight, but the board is not responsible for day-to-day management. So how do you make sure that the E initiative is going to be executed effectively? And executive engagement in ESG management is a complex issue, and there's no one way to handle it. And frankly, all of these issues are new enough in the US with US companies, and some companies are at an absolute neophyte stage and some are at a more mature stage. And they're all figuring out just the best way it works for their organization. But the point is that you do need somebody within management who's held accountable and responsible for executing on the sustainability or other climate related initiatives. About 3/4 of companies have of major public companies have a designated member of management or team that is focused solely on ESG, which would pick up the E, the sustainability, the climate change issues. Often some companies will create an executive committee that's comprised of senior leaders across different business functions, because it's a very interdisciplinary issue, climate change, as I articulated at the beginning of my comments. So you might have people from legal, HR, the ESG specific leader, somebody in product development or sort of on the consumer side, IR, and so on. What's interesting about those interdisciplinary committees or organizational groups is you rarely see someone who's really down in the trenches at the managerial operations level. And since a lot of the climate change issues stem from the operations, you wonder whether those groups would benefit from more input from, the trenches, so to speak. But dedicated ESG or sustainability functions are, increasingly employed to facilitate not just execution on the strategy that the board oversees, but accurate and timely and accessible data and reporting, because that is one of the challenges of the entire effort around climate and sustainability efforts is the data and the reporting and the cost and time that's necessary to do that right, and then the liability that it opens you up to if it's not done correctly. Moving on to reporting. So US companies face extreme demands for particularly environmental, climate-related, sustainability-related reporting from diverse stakeholders, including their shareholders, rating agencies, regulators, proxy advisory firms, and sources of financing. So it's from all angles, and it cannot be avoided. Most US companies at this point have published an ESG or sustainability report and include some form of climate or environmental disclosure of varying levels, widely varying levels, in their SEC filings or the proxy statement. There's a study that shows that 90% of companies in the S&P 500 publish corporate social responsibility reports, which pick up all the different types of reports I said before, which is up from 20% 10 years ago. So we went from kind of 1 in 5 to basically 1 in 1. S&P 500 companies like to set dates for reaching carbon neutrality, not only because there's all this pressure from the constituents I mentioned before, but also because there's actual empirical data that shows that often they trade at a premium to those that have not set those targets. Now, whether it's a direct causation or it's just a correlation, and that's the kind of company that would trade at a better premium, is for a banker to advise, but it is interesting. And companies that publish their emissions, their scope 1, scope 2, scope 3 emissions, like we'll talk about more in a minute, if they publish their emissions and they have a high emissions relative to their peers in their industry group, they tend to trade at a discount to companies with low emissions. So you could see how the incentives could get warped in terms of whether you want to make the disclosure before you've reduced your emissions, or the incentive could be there to publish when you're lower so you can show progress and get the trading bump. US companies that want to improve their ESG reporting processes are very busy right now establishing more rigorous practices for climate and sustainability data collection, management, and disclosures, like I talked about. The use of third-party assurance in the US varies widely. It is a minority practice when outside of a financing context to have the third-party assurance verification, but it is increasing at a rapid pace. And so I bet if we talked again a year from now, I might not even say a minority. Investors in US companies are digesting all this information, all this reporting that I've been talking about. And they, investors in US companies like to compare companies side by side, right? Analysts like to put two companies on a screen side by side and decide which one to invest in. And the trouble with all of this data is that there's a lack of uniformity and an absence of a common framework. And so that creates a real challenge. So there's a lot of time we spend with companies, US companies, trying to think through what framework is best suited for you. Brian's right, the TCFD would be the one you go to the most, but there's many frameworks you can do, which I'll come to just in a minute. But the questions US companies ask themselves when they're trying to decide what framework will fit best is, we always start with, what is your company already subject to with respect to sustainability or climate related reporting? Like, if you're a service provider of any sort, are your customers already requiring in their RFPs for you to provide certain data such that you're already collecting it? Do you operate outside the US such that you're already subject to certain reporting obligations in EU or UK or something like that? So what data do you already have? What are you already doing? Let's leverage that. And then the second two questions are, what are you trying to achieve with your framework? So we go with the goals, and then what frameworks are most relevant for your industry, which dovetails with the goals because it is a competitive process. And then we also think about what framework addresses your most material issues. So if you're a large GHG emitter and maybe you're light on the scope 1, but you're heavy on the scope 3, let's talk about what framework might be best suited to tell that story in a way that achieves the goals we just talked about. And then finally, we talk about who are the intended audiences. What do they expect? What do they want to digest? State Street seeks, if you're trying to court State Street or BlackRock, like they are going to expect you to show TCFD and SASB. And so maybe those are the right frameworks to pick as an initial matter, because they will get you checked boxes with those important institutional investors. And then just a moment on SEC mandated climate disclosure. So for publicly traded companies in the United States, the disclosure that they make in their annual reports and their quarterly reports, as well as certain interim reporting and proxy statements when they're soliciting votes from their shareholders, is mandated by the Securities and Exchange Commission. And the SEC has been increasing its focus on climate change. We obviously had a presidential election in late 2020 We had a change in administration in 2021 that led to a change in the SEC. It flipped from majority Republican to majority Democrat. And the commissioners, the Democrat commissioners who were on the commission at the time and still are on the commission now, had said towards the end of the Republican administration that they were looking forward to rolling up their sleeves and really mandating climate disclosure once the Democrats were in control. And so we had an interim chair of the SEC for a while, and then later in the year, in 2021, we got a permanent chair. Both the interim chair and the permanent chair, Chair Gary Gensler is the current chair, took affirmative steps to make clear that climate was a top priority. They created an enforcement task force with respect to climate disclosure. They created a new office, a dedicated staff of personnel at the SEC who are only focused on climate matters. They issued some forms of climate change comment letters, whereas over the last 17 years, there had been probably an even number of comment letters, and they suddenly put out a flood of them. And they also solicited comments from the investor community and public companies and other participants about the what climate mandated disclosure should look like, why should we do it, why should we not do it, what should it not do, and solicit all of those comments. And so we expect new climate change mandatory disclosure to be coming out in the second half of 2022. Originally, it was supposed to come out in fall of 2021. Some thought it would come out in connection with COP26, but it's been delayed. It's delayed in part because we know that the staff is having disagreements. Well, we hear the staff is having disagreements about the Scope 3 emissions and how that's been reported in the press about Scope 3 emissions and what that should look like. But we also know that the staff has a lot on their plate. They are adopting or proposing a lot of new rules under this administration, making a lot of changes, and including with respect to disclosure that falls into other ESG categories. So anyway, for now, we can take a breath, and those climate mandated disclosures are coming later this year. But in the meantime, it's important, we've gone back and reminded our US company clients that climate change disclosure is nothing new for a US public company. In 2010, the SEC put out climate change guidance that noted 4 topics that could trigger climate change disclosure under SEC rules, including impact of legislation, international climate change accords, indirect consequences of climate change or business trends, and then the physical impacts of climate change. So those are things you're supposed to be thinking about, US companies are supposed to be thinking about already, just under the current reporting regime. The issue with the current reporting regime, or the observation about the current reporting regime, is that it's a materiality based, it's a principles based system, and that's the way our rules are mostly set up. And there's plenty of companies that over the last 10 years would not have said that anything related to climate change or reducing their GHG emissions was material. And materiality in the US, is some information that might be important to an investor given the total mix of information in making an investment decision. So it's an interesting paradigm that the SEC finds itself in, because it wants more disclosure about climate, but there is an absolute valid rationale for not making that disclosure under the current rules. So what we expect the new rules to require is itemized quantitative disclosure. So give us your, disclose your Scope 1 and Scope 2 emissions, disclose exactly how much capital you spent on climate related activities, which will have to be defined, in this year. Like, regardless, even if it's $10, like, you're going to have to provide that kind of disclosure. I mean, those are just examples of things we could see. So that's one thing. And then the other thing that US companies are dealing with is the fact that the staff of the SEC sent comments to US public companies in the fall of 2021. They published a sample of this comment letter, because the SEC, the staff has authority to just issue comments, questions, observations, requests for corrections notes about non-compliance, whatever, on public company, on SEC filings. And so they issued many of these letters to US public companies in the fall, and you can see the sample letter on the website. We've seen many clients' letters, and they pretty much track that form. But it was interesting because the comment letter sort of came and went, and it seemed like it was a bit of an investigative exercise in terms of the staff understanding how companies think about the disclosure that they include in their annual report that they file with the SEC, and the disclosure they include in reports that are not part of their SEC filings, like a sustainability report or an ESG report. And why is there information in one but not the other? Why do you think it's important to say in your sustainability report that you intend to reduce, you intend to be net zero by 2050, or you intend to reduce your GHG emissions by 25% by a certain date, but you don't say that in your 10K? And and because of that principles-based paradigm I talked about earlier, companies would say we're not required to say it in our 10K. So anyway, it's going to be a very interesting second part of the year when those requirements come out. And in the meantime, I'll also note that, well, not in the meantime, but all along over the last several years, there's been multiple legislation introduced in US Congress that would mandate by federal law, by statute, additional climate change related disclosures, several different iterations of those, but none of them have been successful, and we wouldn't expect any of them to pass Congress. Okay, I'll try to go through these next topics a little faster. The next topic was the emission reductions target. So there are sort of US companies are increasingly setting ESG goals and stating them publicly. Like it's just expected. I mean, even the US government has a net zero plan that the White House published in November. You can see it on their website. And so US companies are stepping up to the plate and saying, okay, we commit to striving for net zero by X date, typically like 2050. There's two main forms of these statements. It's the net zero targets, and then it's the disclosure about scope 3 emissions that tend to be the trickiest areas. So a significant percentage of US public companies have disclosed a commitment to net zero goals, such as net zero by 2050. The key for companies in making this disclosure, which is, I mean, to say what you're going to be able to do by 2050 is pretty interesting, because that is a long way away, and the management team that's saying it today, most likely won't be there in 2050. So the key is that companies need to back up their net zero commitments with public transparency. What do they mean? And is it ambition? Do they have concrete steps along the way? So you see US companies more and more breaking the ambition down into interim targets and talking a lot about the strategies they intend to employ to reach net zero, as opposed to it just being this headline of net zero by 2050. It's more like, that's our aspirational goal. We hope that works. In the meantime, we can commit to doing these 3 things in the near term, or reaching this target by, call it 2025, 2030, because it's just, there's a better line of sight to that. And for some of these companies, there's new technology and capital investment that has to be made to reach these net zero goals. So in making this disclosure in the US and managing the US public company, especially's liability in making these lofty statements, it's very important that they're very transparent about all the challenges and assumptions that are built into the statements. And then that second category, disclosure about scope 3 emissions, scope 3 emissions are very challenging to disclose, as you know, especially for smaller companies. So just real quick, scope 3 are the emissions that are the indirect emissions that occur in the company's value chain. So emissions from the goods you sell, in-house emissions of the company's product by consumers or business travel, I mean, just everything indirect. And the use of this metric varies widely depending on the size of the company, like I just alluded to. So for example, in 2021, almost half, 43% of S&P 500 companies disclose scope 3 emissions, but only 1 in 10 in the Russell 3000 disclosed scope 3 emissions. So there's a significant variation in practice here, which is partly a function of limited resources and also a function of maybe less demand from investors and other stakeholders on the smaller companies. There's also a significant variation in the content and scope of the disclosures, even amongst those that do put out scope 3 emissions. Some companies provide details of scope 3 emissions, sort of itemizing what is it from business travel, is it from in-house emissions of the company, while others provide aggregate totals. But the key for U.S. public companies in our liability management regime is to be clear and consistent. Climate-related shareholder proposals. So Brian is the best resource around on this. So if you're a U.S. public company or otherwise, and you get a shareholder proposal related to climate or anything else, you call Alliance, they get on it, and you're all set. But the context in which to put is that there's just historic support for climate-related shareholder proposals at U.S. companies. The number of environmental-related proposals has actually remained relatively steady, but the number of proposals that get to a vote has increased. And then while the overall number of proposals, again, has remained relatively flat, the increase in the say on climate proposals is very interesting. So the say on climate shareholder proposal generally asks companies to publish a climate action plan and to put that plan to an annual non-binding shareholder vote. We have something in the US that's similar to that called say on pay, where every few years a company has to ask its shareholders to approve in a non-binding way the pay that they give their executives. In 2021, there were 5 of those proposals and were voted on. And really interesting is that the support for those proposals has been very high, and the ability to compromise and settle those proposals so that they don't go to a vote is extremely difficult, and the most difficult of all the shareholder proposals that we saw last year. So we will continue to see an increase in environmental proposals that relate from everything from a reduction in scope 3 emissions to required reporting on progress towards the net zero 2050 scenario, to other things like plastic packaging and pollution and other types of management, things that require changes to the way you run your business. And those are only going to increase over time. And then finally, director accountability. So bottom line, the directors are being held accountable for making sure all the things I just talked about happen. The disclosure, the reduction in emissions, the net zero goals, and if the board oversight itself, the naming a committee that's in charge of it. And if a company doesn't take that seriously, then they will see votes against or recommendations against from the large institutional shareholders, the BlackRocks, the Vanguards, the State Streets, and from the proxy advisory firms, the ISS and the Glass Lewis. And, at some point, this was sort of limited to, well, just the chair of one committee, just the independent director, things like that. But it's broadening, and it probably will continue to broaden. And the expectations of these investors and advisory firms are continuing to increase in intensity. And all of these institutions are very good about publishing what their expectations are. And then it's important for U.S. companies, whether they're engaging with the firm or investor or not, to make sure that their public disclosure is drafted in a way to communicate all the points, check all the boxes that are on the list of the investor or the advisory firm that they want to check, try to assure the best vote for their shareholders. And then just the last thing I have to throw in is back on the sustainable financing. Another thing that holds directors accountable is the company performing poorly. And one thing that can cause a company to perform poorly is not having access to capital. So the movement of sustainable financing, green bonds and sustainability linked bonds and sustainability linked loans and so forth, blue bonds for energy transition, moving into the United States is something that if companies don't take advantage of that, directors could ultimately be held accountable for not taking advantage of all opportunities to access the cash they need to run the business or to pay for all these ESG initiatives that they're being required to do. So I'll stop there. There's a lot to go.
If I may just jump in with a couple of comments. So one of the key themes I think you identified is the importance of engaging with your shareholders. You talked about it in terms of the director voting and understanding the policies of your largest institutional investors. And it really goes from all the way down your list. You want to understand their oversight expectations, their reporting expectations, the goals for your net zero, your scope 3 emissions, as well as how they'll view shareholder proposals. So it's a great opportunity for companies to have direct feedback and dialogue with their largest and key shareholders to understand their perspectives on this type of issues so they can be as prepared and the board can be prepared for the annual meeting. And there are no surprises when it comes to the annual meeting, and they're able to position the company in a way that meets the objectives of their shareholders and also in doing so serves the company performance. So I think it's a real interesting theme that you see how all these tie in and how you can get such great feedback from your shareholders on a lot of these topics. So with that, let's kick it off to the South African team. I don't know if Eugene or Hendrik, you guys want to start and provide what you think are some of the key issues on the environmental side in South Africa.
Eugene, shall we take it from the top?
Yeah, you go for it.
Yeah, okay. In South Africa, there's currently no regulations that would require you to report on any of the ESG themes. And so it would be up to the likes of Eugene running an exchange to perhaps put those regulations in place, recognizing that they are in competition with other regulations and they might want to avoid, sort of friction. But then again, I know that Eugene only wants the best companies on his exchange, so that's probably a good thing. The major impetus in the local market to report on the environmental impact themes has been from the pressure to obtain international investment and capital. And we saw that locally, where all the major banks sort of unanimously announced that they would no longer be funding fossil fuel power plants. And that was directly due to the fact that for their bonds to be acquired in the international market, they had to move away from financing dirty power. But other than that, the local market is sort of saying, what is the easiest way for me to show a positive impact on the environmental considerations? And they do that by focusing on renewable energy because it easily slots in within their operating framework as it is. Hillary previously mentioned, if one is truly committed to the ESG themes, then it actually becomes intertwined in your entire business strategy. It's not something you can actually separate out. So there has to be an E part of the impact strategy. And we just don't currently see it. It's sort of an after the fact reporting that's done due to sort of companies knowing that investors are starting to look at ESG considerations other than financial considerations in making investments. So due to the fact that there is no reporting requirement and that sort of the local investors don't really have options, therefore they can't vote with their money elsewhere. We see limited reporting, and even if there was, I think, a requirement to do so, there is not a supply of qualified individuals, experienced individuals who can assist companies with actually formulating impact strategies which intertwine with the rest of the business strategy. So Hillary mentioned it earlier that she said that perhaps, currently there's a minority of companies reporting, and in the future she would imagine a majority of companies would be reporting and would be utilizing third-party verification agents to put their stamp of approval on the reporting that's done within the ESG themes. We don't know where those people are going to come from to assist with that, and we, being in the process now of establishing a Africa dollar-based fund to be domiciled in Europe, We understand the intricacies involved and that it's a full-time job of someone to do that. And you probably see in the future with the requirements in Europe, there's the SFDR, the Sustainable Finance Disclosure Regulations, which is putting out regulations which requires companies on a standardized basis for reporting purposes. Like Hillary earlier said, people want to report two companies side by side. The framework puts that into, it's trying to put that standardized model out there. So if one is to say that is what one wants to do, I would imagine that reporting on ESG would become similar or akin to financial reporting, with auditors and an entire industry being created around that. From an investor perspective, as we said, due to a lack of options to invest in companies which is paying attention to the environmental perspective, the focus remains on financial considerations. And because they don't have a lack of options, they can't just sit on their money. There is no alternative. It's financial considerations are still being given the upper hand. Naturally, if there's a good investment case and there are environmental considerations and disclosures and an environmental strategy in place, I'm pretty much sure that sort of the money would flow into that quite considerably, given the lack of options that there are here. There is either an increased pressure from investors on these companies to start reporting on their ESG impacts or themes, and we're seeing that with niche funds being created. The fund management industry is like anyone else, any other market, so they're trying to differentiate themselves from the competition and saying we've got an ESG fund and we will only invest in companies with a positive ESG impact. That still being said, I am unsure as to what their options are other than the existing companies which are internationally, well, they might be domiciled in South Africa or initially were domiciled here. I'm unsure as to what their options are other than those large companies who are reporting currently because they are trying to attract international capital. That is to say, local companies, who doesn't have aspirations to attract international capital may be slow to adopt willingly ESG reporting requirements. And lastly, what we see from an investor perspective is that family offices are at the forefront of, South African family office, naturally, it's also the case in Europe and the US, but South African family offices who have reached a level of return, and are no longer requiring where financial considerations aren't the absolute consideration within the investment decision, are the first ones to make their money speak for them, and really providing it as a carrot and a stick to the companies that they and the funds that they are investing in. And the other fund managers and investors are actually following their lead and saying, well, what are the investments, what are these investors achieved over time, and whether there's something that they should be paying more attention to. And it might be a case, as Hillary said, that the companies that are doing this type of reporting, who are paying attention to it, who are embedding it within their overall business strategy, are the type of companies that you want to be invested in. There's good management, I think it's probably a case that is, but the investment world is small. So if someone's making money and they're saying, well, we're making money because we are only investing where E is a considerable part of our consideration, I'm pretty sure that other fund managers will soon follow suit due to the investors phoning them and comparing them to the rest of the market. Over to you, Eugene.
Cool. So show me your biggest problem, then I'll show you the biggest opportunity. And I think that's the stance we've taken at the Cape Town Stock Exchange, which is right now with the absence of any significant regulation and enforcement of disclosure onto entities, it's been very much an investor-driven proposition. South Africa is the 16th deepest securities market in the world. And with that comes with it between 40 to 60% of international participation in terms of investors. And a lot of them are looking for a prerequisite level of disclosure and specifically related to ESG environment. So we've taken a very much a principle-based approach in terms of how we look at it. First and foremost, the governance and culture. And in there, South Africa follows the King corporate governance guidelines in terms of the board, the composition, but also in terms of the integrated financial reporting and what those disclosures look like. We've asked for an enhancement on those disclosures in terms of our debt listing rules, specifically looking at how you disclose any of your ESG, the good and the bad. The important bit is we make a key distinction around whether your underlying green or social sustainability bond is dedicated to a specific project or development of a certain project, or is it related to certain sustainability linked criteria that you're looking to achieve at the firm. And it's important separation. If it's related to a project, we go and we analyze the use of proceeds, we analyze the project through evaluation and selection, and more importantly, we go and manage those underlying proceeds and see how they are deployed against it. And then ultimately go and see that the outcomes of that underlying project do achieve those underlying goals. And where there's an expectation of that reporting is done within the project. The second component is where you set yourself sustainability linked objectives. And in that one, it becomes more important in terms of how management dictates those underlying KPIs or those underlying sustainability performance targets within the business, both in the medium term and in the longer term, and how they go measure those targets against hopefully some type of external measure like Paris climate goals, UN sustainability development objectives, or maybe even down to clean air or meeting carbon neutral or carbon neutrality for the underlying firm itself. The second bit we do is looking at the underlying impact assessment. And there's an expectation that the business, not just as it currently stands, but how it's able to identify and manage all those business lifestyle sustainability impacts. A business that's already doing something doesn't get to get a carbon offset around doing the same stuff and therefore get to benefit. We're looking for someone to make attempts around accretive changes to the underlying sustainability goals. The stakeholder engagement is really important, and that's not just looking at what underlying solutions, products, services you meet, but more importantly, what's the collective action you introduce over there? What are the other partners you bring into the equation? Often it's around not just sustainability benefits, but community benefits, etc. And those are also measured within the KPIs and attached to the project. Transparency and disclosure is where there's the least amount of guidance. But this is where it's quite important in terms of that initial assessment around governance and culture. Is sustainability embedded within the firm that's attempting to make the listing? If it is, then that reporting component often becomes a lot easier exercise. Secondly is investors play a massive role in terms of what that required reporting is. So where we are fortunate is in all the underlying sustainability bonds or issuance or debt issuance are usually pre-negotiated, and they are securities that are listed on a public exchange. So with that usually comes a series of measures that investors seek to see fulfilled, and they also seek to see those measures reported on. And the reason for it is because very often those disclosures are usually what trigger covenants around non-performance and often punitive measures against the issuing entity in terms of achieving discounts for that finance or achieving discounts for that equity-based finance. And then more importantly as well, can you build up that reporting that there's a genuine alignment between investees and asset managers, and in terms of what that looks like. And then lastly is we do prescribe the Sustainable Stock Exchanges initiatives and their pre-disclosed template for disclosures and what it needs to look like. So it's developing in South Africa. It is nascent, but we do have the benefit of hindsight, and we do have the benefit of looking at the mistakes others have made and making sure we can calibrate that in our own context. The other advantage for the Cape Town Stock Exchange is we are a self-regulating entity. We do have dual regulation from our Prudential Authority and the Financial Sector Conduct Authority, but in terms of the regulations we set for our issuers is in line with our debt listing rules. And it's in those rules that we enforce the underlying sustainability, not just sustainability disclosures, but also the underlying measures. And we do have the ability to take punitive action in terms of fines or even action against directors in terms of their behavior in line with those underlying objectives, but also in line with those underlying promises that they make to investors. I did want to leave it off. I put something in there around size matters. And this is something that's becoming more and more important as we are seeing the emergence of real supranational funders coming to the fore, specifically in the South African context, to fund these initiatives and also fund the underlying discounts to provide people with more beneficial funding rates. It's very difficult to allocate funding on a very small project. And the reason for that is to devote analysts to those underlying projects to analyze them. So the preference is for larger projects or the assets to be accumulated and then the off-takers to participate in that. If we don't have some level of standardized disclosure, some level of standardized rule set, it becomes very hard to begin to bucket those underlying exposures into tranches that are big enough to achieve the offset we're looking for. Hendrik was quite right. The natural offset in South Africa has largely been family offices. We don't yet have the significant institutional offset to buy up these underlying debts, so very dependent on international financing. And we are hoping that this rule set actually standardizes that, and the rule set around disclosure standardizes that and makes it a lot easier. And then I do want to talk, we didn't really define the E at the start, but too often we focus on the energy component or on the underlying renewable component. But I think there's much bigger projects that play in South Africa that fit that definition. And it goes beyond energy, everything related to transport, water, buildings, land use arrangement. For us as well, land use and marine resources, huge coastline. And then lastly, specifically waste control, and even some of the developments into the ICT space and how it attaches and the social implications that are attached to that, but also the energy offset usages in ICT, which at the moment is not topical, but I think is going to become a bigger and bigger problem in terms of the underlying usage that's attached to ICT in general. I'll leave it there. Thanks, Brian.
So there's a lot, I would say, of similarities and a lot of differences that we've identified throughout the conversation. I just want to highlight some of the things that I found striking in the conversation. The first thing that I noticed was the reporting seems to largely be driven both on the US side and the South African side by investor expectations. As investors make increased demands on issuers to increase the disclosures, that's when the reporting seems to grow. So I anticipate as that continues in South Africa, the reporting system will be more similar to what it is currently in the United States, and we'll continue to see that snowball on itself. The other similarity that I noticed was the desire for capital and the need for investment from large institutional investors and their desires for and their expectations on companies' environmental, social governance policies, and that driving some of the need for companies to change some of their practices in this space. So those were some of the similarities that I identified when you guys were talking, when Hillary was talking. I'd love to get your guys' perspectives real quick if you had any the key takeaways.
Yeah, I'd maybe add to it, Brian, which is I think ESG is topical, and I think it's currently a little bit of a land grab on the go. And I think at the moment companies are ahead of the curve, or those are able to box their underlying ESG components nicely, and it satisfies investors. But I think if we fast forward 5 years, it's not going to be about who can package it. I think it's going to be a really imperative for those hydrocarbon abusers, etc., for all of them to have this in place. If they don't, I cannot see them funding their underlying businesses on a go forward if there's not some type of trend to ship themselves off those abusive practices. And I think that's the push from investors now is the carrot. I think the carrot will shift and it will just become conventional finance 5 years from now. And then it's rather the whip's gonna catch you, because if you haven't adjusted, you get caught out.
Yeah, I entirely agree with you, Gene. I think if you're not pivoting to making ESG part of your impact strategy, when the reporting does become a requirement and you are laid bare, you're going to be quite embarrassed as to the state of affairs at that point in time. It should be something that you're proactively doing and seeing it as you rightly said, Eugene, as an opportunity, not as something else. To work with your investors. I mean, I'm pretty sure a lot of these investors, if you show them your impact strategy going forward. They will support you through tougher economic times because they know where you're going. You know, and I think they could be a bigger relationship other than pure, you know, sort of greed and profit between investor and company.
Well, thank you both so much for your time today. Thank you, Hillary, for your time as well. Thank you to everybody for attending today's webinar. I don't think I missed any questions, but if I did, please feel free to submit questions directly to the panelists. Everybody's email address is up online. And if you want a copy of this presentation, I'm happy to send it along. We also recorded it so we can distribute the full presentation to you as well. So on behalf of Alliance Advisors and the Cape Town Stock Exchange and our panelists, thank you so much for joining us today, and have a great rest of the day, everyone.
Thank you.
Thank you very much. Thanks, Brian.
Bye, guys. Appreciate it.